Good morning, everyone. Welcome to the Macro Snapshot. We're Thursday, August the 28th, 2025, recording this in the morning. Okay, let's just see what's going on this morning. There's a little bit of data just to get us kicking off. I don't think it's going to be particularly market moving. We have the second reading of the GDP here, which you can see last is expected to come in at 3.1. So I guess that's kind of interesting just to see, if there's any sort of revisions to that. I don't know that, as I say, it's going to be hugely market moving. What's possibly going to be of more interest is going to be the initial jobless claims, expected to be at around 230,000, and the initial claims, and of course the continuing claims up to 1.966 million. What is interesting is just whether the US. Let me just pull this up. The US sort of labor market is in fact weakening or not. And looking at the continuing claims, there does seem to be some evidence that although the jobless numbers are not massively higher, it's getting harder to sort of get a new job once one is sort of fired or let go. And you do see here that this is a choppy number, but what we can see is that indeed it does seem to be sort of ticking up, although from a sort of a longer term perspective, let's just sort of drag this out a little bit. You can see that it is definitely sort of moving upwards a little bit in the last bit. So that's potentially a sign for the bears anyway that that the labor market is weakening. Now, if we actually look at the initial jobless claims itself, let's look at the 4-week moving average, which is a little less choppy than the headline number. And I'm just going to put this again on a graph. Okay, and again, what you can see here is that it's moving up and down. But again, if you look at these numbers, you've got 220, 230, 240. All of this is very healthy. And if we actually just zoom back out, so let's just take this back a little bit in time. You can see that, it's fairly consistent. So there's a little bit of variance. But at the end of the day, again, not coming out of the COVID period, but you can essentially see that in the last 3 or 4, 5 years, this has been a strong job market. And there's no particular evidence now. People say, oh, look, it's going up. But I mean, you could point back to the last 4 or 5 years. So my personal view is that what a lot of analysis is saying, and it seems to be borne out by these charts here, is that it's a sort of a fairly flat labor market in the sense that people, there are some people losing their jobs. There's not a lot of hiring, and it's quite difficult to get a new job. So it's kind of flat. People are not really being fired that much, but there's not a lot of active sort of job openings by companies. So it's a fairly flat market, and of course we have a lot less undocumented labor and immigration going into the US, and that's meaning that whoever does lose a job, there's maybe less competition there. So that's where we're at with that. In terms of other data today, we do have the 7-year auction in terms of the bonds. The 2-year auction on Tuesday went very well. Yesterday's 5-year auction was sort of, I would say, average. And as we get further out the curve and longer in duration, and today's the 7-year, as I just said, that could be a little cause for concern. So that's going to be interesting in terms of the bond market to see if that is sort of well received or not. Finally, what is interesting, later today we get Waller from the FOMC, from the Fed speaking. And Waller, you'll remember, he gave a quite important speech probably about a month ago now, where he essentially saw evidence that the labor market was in fact weakening and that the economy in fact was also potentially slowing down. And that's one of the reasons that he argued for sort of cuts, basically. He wanted to sort of cut interest rates. And of course, he's in the framework potentially to succeed Jerome Powell at the Fed. So what's going to be interesting today in terms of Waller's speech is just whether he maintains his dovishness, his slightly pessimistic viewpoint for the American labor market and also the broader economy in general, or whether he's firmed up and maybe is less dovish, or perhaps is even more concerned and might even argue forcefully for a 50 basis points cut. So anyway, so that's going to be quite interesting because he normally has a fairly logical and cogent rationale for his sort of pronouncements. So let's hear what Waller has to say. And indeed, let's keep a look on the front term of the bond market to see if there's much reaction. But as I say, much later in the day. Just in terms of the Fed, let's also just quickly catch up and just see where we're at with the Fed. Just a couple of interesting things. Just to remind ourselves that nothing really has changed in the last 24 hours. For September, the market is more or less pricing in almost an 90% chance at this point of a cut. So it would seemingly take a lot to derail that. If we go further out in the year, again, it's just over that two cut level, so about 55 basis points at this point. What is interesting, just wanted to show you something. What the market seems to be saying is that longer term, and this has implications for the 2-year, is that what I've got here is the spread between December 25 SOFR SOFR contracts, so that's the 3-month short-term contracts, and December 26. And you can see that essentially now for quite a long time, basically, essentially since Trump took power, sort of February, March kind of period, we've seen that that spread is now, about 80 points of difference. And just looking on a price, that's the spread here. And if you look down in the lower panel, it's the price. And we can see here that, basically from the beginning of this year, you can see that this sort of dusty lavender sort of calendar here, which is the 2026 contract, so December 2026, you can see that they were essentially trading together, but it's now outperformed the December and 2025 contract, which is this sort of pale blue one here. You see how they've started to diverge more and more and more. And essentially, you see that the pricing, more or less for December 25, is stuck around this, about 50 basis points or so. So you take 100 minus the price, and then you subtract the Fed funds rate of 4.33, the current Fed funds rate, to get the implied yield. And you can see that that's sort of essentially, saying about 50, about 50 odd sort of basis points of cuts. Whereas if we go up to the December 26, you can see that it's about 75 basis points more. And more to the point, it's actually diverged quite a lot. So what that's saying in sort of simple terms is that the market is saying, okay, we might get a cut or two in this year, 2025, but we believe that the more serious cuts or bigger cuts and potentially a weakening economy will really be a story in 2026. So interesting to keep an eye on that divergence as in terms of what the market might be worried about. Okay, so looking at other stuff, we also, of course, had the big famous NVIDIA earnings. Basically, from most metrics, let's just have a look here. You can see the NVIDIA chart here, very, very strong chart. Down in the pre-market I think it's about 2% or so, so down to 179.33. The closest 181.60, so down a little bit. And that's interesting just because the earnings are great, the profit margins are great. Like, this is a very wonderful company. Everything is amazing. But the problem is that the guidance was a little bit circumspect. There's problems and issues around China, and we know that at this point, NVIDIA essentially said yesterday on the call that they hadn't earmarked any earnings coming out of China, any exports at all. So there's kind of good and bad news there. I mean, as we know at this point, in theory, there's a sort of an agreement between NVIDIA and the U.S. government, for the U.S. government to take 15% of sales and chips, especially, the H20, which is the most high-tech ones. But that's not yet codified. And basically, NVIDIA sort of tippy-toeing around, essentially saying that they're waiting on the U.S. to get the government to get their act together, because they don't even know what the exact agreement is, and they use the sort of diplomatic code term, not yet codified. So essentially, that could be upside, though, for NVIDIA, because if that is codified and that's organized and, exports do start to flow to the US, there could be apparently up to about $50 billion worth of export sales with the H20 chips, which, of course, would be wonderful news for NVIDIA, and a bit of taxation for the US government. It looks like we're having a dirigisme, as we say in French, so state intervention into capitalism. Anyway, the other issue as well is that, as part of the sort of the results yesterday, the results weren't quite as stellar as the market, some commentators had hoped for, a little bit under those expectations, but above consensus really. There was also some concern that AI data centers weren't being built out as much in the future as perhaps they are being now, and that would decelerate. So overall, just to sort of simplify and sort of summarize, basically NVIDIA doing wonderfully well, but there is some sort of concern or sort of understanding that the 18 to 24 month horizon, things might start to sort of deaccelerate and sort of start to plateau at some point. So is this still a wonderful company? Yes. It's the largest market cap, obviously, in the indices, especially the Nasdaq. And so, Nasdaq, and there's no reason, I don't think, for this to fall. It could be a profit taking or something, but at the end of the day, NVIDIA's earnings, in my opinion, are not really a justification for any kind of medium or longer term fall in the tech stocks. But we'll see how they trade today. In terms of other stuff, what is interesting is just looking at the bonds. And we continue to see just weakness over in France versus the German bonds. As we know, on September the 8th is going to be the no confidence vote. But if we just put this into context here, you can see that things have come off a little bit. But we've had yesterday as well, continuing not a steepening but a divergence, sort of a blowing out in these spreads here. And you see that we went from about 68 basis points of the French yield over the German up to about 82. Now, as I say, it's come off in the last few hours, but pretty powerful sort of rip higher of about, what's that, about 15 basis points, 14, 15 basis points or so. And that's just showing that, that there are, potentially nerves about a lack of fiscal discipline in Europe. And a lot of that is being caused, and I just want to show you a chart here, a lot of that's being caused essentially by the policies of the ECB, because the ECB essentially has come out after COVID and said, well, hey, they have the transmission mechanism now, which is this sort of stopgap measure, which essentially says that, if bond spreads blow out too much, we'll come in and buy, all of the bonds of the countries which are not being fiscally conservative. And essentially, during the COVID period, we had a situation whereby the ECB almost took off the market. They almost bought 100% of, Spanish, Portuguese, Italian bonds, essentially to keep those spreads from fragmenting, as they like to say. So fragmentation is this idea that the spreads on the peripheral nations, which are less fiscally sort of prudent, their yields will go up a lot higher compared to, let's say, Germany or Holland or Austria, these kind of countries which are more fiscally prudent. And just to see this semi-strange situation, we've got here an interesting little graph here. We have on the x-axis down here, we've got the government debt as a percentage of GDP. So obviously, the higher that is, in theory, that's the worse it is, so to speak. And then here on the left-hand side here, the y-axis, we have the deficit. Okay, so we're trying to see who's running a deficit or a surplus, and you can see that most European countries are in deficit. But what's interesting here is that you look at something like Italy, which is outperforming. So Italy has a higher sort of debt to GDP ratio than a lot of other countries, and it has a pretty bad deficit here, and yet it's being rewarded by the markets. And a similar kind of situation here with Spain. So you look at Spain and Italy, and poor old sort of Germany and the Netherlands here, who not running much debt at all and have a much lower ratio of debt to GDP. You see here the Netherlands just over 40, Germany just over 60, very different to these other countries, which are sort of over the 100. And yet, in a certain sense, all of these spreads have tightened. And you have to ask yourself if that's sustainable in the medium term, and really what's causing that. And really what's causing that is the political action of the European Central Bank, which essentially is sucking up all of these kind of bonds, like sort of Belgium, Italy, Spain, Greece, Portugal, all of these kinds of bonds, and trying to keep these spreads not unfragmented and pushed together. So that's interesting to just keep an eye on that. I don't think that there's the political will in the European space to make any force any tough decisions. But the point I'm trying to say is that this is the reason that if there's any sniff of things getting out of control, you can see how quickly in the French situation that's pushed up. And so let's keep an eye on that. Obviously, probably the next major catalyst, probably the market's done what it needed to do, is going to be for the no confidence vote as we get more into September. But just also keeping an eye on that, if you look at Italy here, you can see here, just as that spreads come in just to over about 90 basis points now, all the way down from about 2% a few months ago. So just to keep an eye on all that and understand that a lot of this is not necessarily because Italy is doing wonderfully well. It's a bit better, but the European Central Bank, as I say, continues to sort of in a very heavily weighted way suck up a disproportionate number of these bonds from the periphery, which is pushing down their spreads in, some would argue, in an artificial way. Anyway, interesting to look at that. Also, just want to have a quick look at oil here, guys. So we had the numbers yesterday. Hold on, where's oil? We had the inventory numbers, which I'll pull up in a second. They were quite supportive for the market. Again, oil's at this interesting point here where it's not really doing a lot. It's just sort of trading is in the lower end of its ranges here. It's come down. It's still awaiting clarity on Russia, the global markets, the tariffs, all this kind of stuff. And of course, there's a general consensus here that there will be a surplus going into 2026. Just as maybe the global economy slows a little bit, and secondly, as production outstrips demand, especially we see OPEC Plus getting back towards having more than 2 million barrels a day. But it is interesting, just at least in the context of the United States here, to look at just where we're at. And the numbers are not bad. When I say the numbers, I mean, some of the sort of the metrics here. So if you look at crude oil inventories, you can see here that this is the 5-year range in the blue. I think I showed this a week ago, and this is the 5-year average in the red. And so you can see that here the inventories for this time of the year are in about week 34. You can see they're at the lower end of the range. So that's, relatively supportive in terms of the inventories here. You can see also at Cushing, which is one of the main distribution points and the pricing point for the WTI contract in Oklahoma. So you can see at Cushing as well, pretty much seasonally, very supportive for the price in the sense that it's quite low. And that's one of the reasons that the curve is still in a backwardated state here. The other thing is here, if you look just overall oil production, you can see here that it seems to be flattening out, 2024, 2025. Looks as though we've reached some kind of plateau here and maybe even coming off a little bit. You can see that refinery demand went down a little bit in the last week, but overall for this time of the year, the refinery demand is at the upper end of its ranges. So that's also relatively supportive. The inventories here, what have we got here? I can't see it. Distillate fuel, you see that's also doing pretty well. You can also see here one of the bright spots is also for jet fuel and some of these industrial applications for crude oil. You see jet fuel here. This is 2025. You can see for this time of the year in the black is at the top end of the range, so doing pretty well. So the point I'm trying to make is that going back to the WTI chart is that there are some reasons to be sort of bearish in oil. You could talk about a little bit of too much supply, not enough demand, potentially a weakening in demand out of China, out of India, who knows? There's a lot of things. But the point is here that the price is not collapsed back into the 50s and seems reluctant to do so. And as I say, yesterday we did get another pretty good drawdown in the US, and as we saw that some of the broader metrics are not bad in the US space, and so possibly something around about $60 is some kind of sort of intermediate low, and then it's just a question of whether it's going to trade down to about 60 and maybe up to the $70 range. So probably just in a trade range at the moment. But as I say, looking at the overall metrics, it's not horrible. It's quite supportive in a sense. And if we get some kind of boost from, let's say, the global economy, that could be ultimately supportive for oil. Let's keep an eye out for that. Okay, so that's about it, guys. As I say, stock's doing quite well. Still fairly sleepy. We're going into the Labor Day long weekend of the US. That's kind of the end of summer, so to speak. That's on Monday. So we have, as I say, a little bit of data coming up with the initial jobless claims, continuing claims, and a second reading of the GDP. Let's see how that goes. Got the dollar here just sort of meandering along sideways. And then, of course, we have the PC tomorrow to wrap up the week before the long weekend. But I'll leave it there for now. Thanks very much. Have a great day, and we'll keep this going tomorrow. Thank you.